And usually, when someone talking about raising money for a fund, most people invest in multifamily, commercial real estate. It's not a. There are some people that have funds for single family rentals, but not a lot. What had you guys choose the single family home rentals for your fund versus multifamily?
Yeah, that's a great question. And we certainly own some small multifamily. But really, at the end of the day, it comes down to demand, supply and demand in the markets that we invest in, and just our resources at the end of the day. It's not that we couldn't be successful in multifamily, but we could be very successful in single family with being that we do all the construction in house. My partner Ron has been a construction manager, GC, for over 20 years now. There's guys on the crew that have been with us for over 15 years, been with him. So we can execute in that space. And in the markets we're in, Philadelphia, Baltimore, certain parts of South Jersey, there's a massive supply constraint for affordable and workforce attainable housing in the single family side. So we just see a massive demand there. Baltimore especially has a ton of opportunity to buy dilapidated homes, vacant properties that are run down where you can buy them at a very significant discount to market and then go in and essentially redevelop, rebuild within the four walls and then do with it what you keep it or sell it. So we just look at supply and demand and then what our ability to execute is. And the single family space, because it's scattered site, because it's urban metropolitan areas, because we're in the markets we're in, we're not really competing with large institutional players that are doing built to rent communities or in the affordable housing space. Some of the money that's come from the government and things like that has gone more towards apartments and a lot of times the affordable type apartments. They're studios, they're one bedrooms, maybe two. So it's hard for people to find space in that product. So that's really where we see a very strong demand. And it's one of those things where I like it because it's not as cyclical as some of the commercial real estate is, where it booms and then it busts and booms and busts. The supply and the demand aspects of workforce and affordable housing, especially when you take it to that next level of dialing in specifically to single family, there's so much constraint and so much demand that it's somewhat isolated from a lot of the craziness in the marketplace. And it's good too from a recession kind of proof investment strategy, in the sense that if you look at the data, workforce affordable housing tends to do better than any other asset class, including market rate apartments and things like that, just because of the sheer demand. There's historic high demand in that space now. And then if we were really in deep recession, that kind of thing, you tend to see the demand for that go even higher.
Gotcha. Okay. You had mentioned you guys have six different funds. Um, how, how do you decide give us an idea of like how much asset under management for each fund, and yeah, how you guys decide to I guess close out the fund and open up another
Yeah.
one. Yeah.
Yeah, that's a good question. Yeah, because it just happened that way. No real reason to have. We have four. We have GSP one, two, and three, and then we have our growth fund. So originally, when GSP one opened, that was going to be our rental property fund, and GSP two was supposed to be our note fund. And we launched we launched GSP1 in November of 2019. COVID hit very soon after that in the beginning of 2020, and the product that we were buying from HUD had dried up. They pretty much pulled everything off. All of that has come back in full force, but at that time they pulled it, so we really didn't need GSP2 to be the note fund. And
Uh,
in the meantime, my partner Wade had went out and he got a private equity partner that funds the entire side of that business. So they've committed 150 million, and the partnership works a lot better because it, the trades are typically upwards of 150 million. We'll bid the whole entire trade, but we never win that much. Usually we'll win 20, 30, 40 million, something like that. So what happens is if you bring that money in, you need a partner where it's like you can draw on the capital if needed. It's there for you if you win the whole thing, but if it's not there, you're not paying on interest on 150 million or something like that. So that relationship made a whole lot of sense. What we ended up doing was GSP2. Just we had the 1 year fund with GSP1, and we had the 3 year fund at GSP2. So it's just from a logistical kind of standpoint, operation standpoint, there really wasn't much need for that. So at this stage of the game, pretty much both of those funds have everybody's rolled into GSP3. There's some legacy investors there just because of terms and things like that haven't come due. But I think in the beginning of 2025, those funds will be closed and wound down. And GSP3 essentially does the exact same thing as GSP1 and 2 does, but it breaks up terms and the amount we'll pay and things like that through classes instead of having two separate funds, which is always if that was what we intended from the beginning, that's what we would have done, but it just happened that way and with the market, that kind of thing. And then our growth fund is just a different structure. So we have what we call the income fund and we have the growth fund. The growth fund's more of a traditional, we pay a preferred return, we split profit and equity, investors receive tax advantages, that kind of thing. The income fund, I like to call it our in-house private credit fund. So it feels very much like a private lending, a private credit, a hard money type of a fund where you're paying a fixed rate for a fixed term. But instead of lending it to a third party, we're the operator. We're the owner operator. All the capital that comes into that fund, we use for acquisition and construction costs. So we're managing the time frames, we're managing the budget, we're managing the projects, that kind of thing. So it provides a little diversification than your average private lending fund where they're bringing money in and then they're lending it out. And a lot of times those funds will be structured where they'll have maybe a 6 to a 8 or 10 pref. And then your upside might get you 10, 12, something like that. Our fund, we just do a fixed rate. So it's depending on what you invest, it's between 10 and 12%, fixed rate, fixed term. And there's no UBIT. So that's one of the big differences that you'll see in a fund like that compared to our growth fund, which the way that it uses leverage and provides upside, investors in a self-directed retirement account could feel a UBIT hit.
Gotcha. Okay. So give us a little bit more details into each of those funds in terms of the terms of the fund. Yeah, let's talk about the debt fund first. Right. I guess you call it the GSP3 fund.
Yeah. Yeah.
Yeah. What's like, how long is the investor tying up investing into the fund for? Like I guess your different classes of shares, right? Give us some insights into that.
So we have a 9-month, a 1-year, and a 2-year option, and you can extend those options. So if you wanted to do, the difference is what we'll pay. So for a 9-month term, we'll pay 10%. That's per annum. For a 12-month term, we'll pay 11, and for a 2-year term, we'll pay 12. And then the minimums are different. So I think we do a $10,000 minimum for the 9-month, and then 25,000 for the 1 year, and 50,000 for the 2-year at 12%. I like to give people the option to invest longer if they want to. We're not going to pay more for that, but a lot of times people are investing with their self-directed IRAs. In the past, in GSP1 and 2, we had longer term options where it was 5 years to get 12%, that kind of thing. And that was a very popular offering. A lot of people did that. So I wanted to continue to offer that. As long-term investors, we like to know capital is going to be there longer than shorter. And one of the reasons we were willing to shorten up the term is we understand things have changed in the marketplace. Investors are looking for different things and stuff like that. So I think it's important as a fund manager, as a capital raiser, to always be having those conversations, looking at the market, look at what's going on, the external circumstances. And if you have the flexibility in your documents and things like that, maybe through side letters and that kind of thing, it's important to ebb and flow along with it in order to stay competitive. And too, depending on just how bullish you are in your acquisition side and what you're buying and things like that. So for us, we could shorten it because doing this for 10 years now. I know most people, if you do what you say you're going to do, you pay on time. Most people are going to stay longer. Most people are going to add new investment over time. So there was really no reason to force people to stick around for a 5-year term. So that's why we were confident to say, let's do a 2-year term instead. But it's funny. I think mostly all of the new investors that have come into that, except for a few, have done 3 years or 5 years, that kind of thing. So it's great for us. We know it's going to be invested longer. And then for them in an IRA, they want to set it and forget it at the highest return that they can. So it works out great for them. It's a win. Essentially, it feels like interest only. So you invest, you take whatever yield you're coming in at, the 9 to 9, 11, 11 or 12, take that and then divide it by 12, and that's what you should expect to receive on a monthly basis. Or you can compound your payments if the payments, if you don't need them, whatever your goals are, that kind of thing. And then in the growth fund, that is a little bit more of a traditional split in the sense that we pay a 6% preferred return. We do structure that to feel like interest only as well. So it feels like our income fund where we pay that out on day one, and we've modeled it that way. And then we split the profit and the equity 50-50 above that. That is, on a semi-annual basis upon availability, profit would be distributed. And obviously you would feel your equity when you would realize it when you exit the fund. We do that as the paperwork allows investors to request redemption as early as 3 years. We tell everybody to look at it as a 5 to 7 year hold. And if people wanted to stay in longer, they could do that as well.